All right, Insurance and Money Podcast. What's up, everybody? It's Will talking about your money, stashing some money away for those rainy days, right? Emergencies. Some of you guys that want to have a higher deductible so you can have cheaper monthly insurance. You got to put that money somewhere. So, Ben Luthi wrote an article, Yahoo Finance. 4 best and worst places to keep your emergency fund. We're going to get into this real fast. An emergency fund can provide a much needed relief in the event of financial hardship. However, where you put your money for rainy days can be just as important as how much you save. Very true. If you're unsure where to keep your emergency fund, here are some of the best places to consider. We'll also consider or provide a few options that may be tempting but should be avoided, at least for particular financial goals. All right, so features of an emergency fund account that you should be looking at is number 1, low risk. The purpose of an emergency fund isn't to build wealth, rather it is to manage potential risks to your financial well-being. So you need that money there, right? When you need it, you need it. Stashing your money in an account that won't maximize your return might seem inefficient. However, it's more important to avoid potential investment losses that could jeopardize your ability to weather financial storms. So just because, here's the saying, sometimes I want the return of my capital, then I want a return on my capital. For me, always make sure I get my money back, the principal. So I am more interested up front of getting my original capital return. Sounds conservative, but that's me because I like to know where I stand, right? Now, yes, I would like a return on the capital, right? Return on investment. But you want to make sure, especially if this is your rainy day fund, you know, your stash in case of financial emergencies, you want to make sure you can at least get that money back if you don't get a return on that capital. Also, liquidity. Liquidity refers to how quickly you can convert your money into cash, okay, or your investments. Because financial emergencies are rarely predictable, your best bet is to store your rainy day fund in an account that offers listen to me, in an account that offers quick and easy access to your money when you need it, all right? You also want penalty-free withdrawals as it relates to that. Some accounts assess penalties if you withdraw your money before your account agreement allows. These early withdrawal penalties can wipe out any interest you've earned and even eat away at your principal balance. Remember, we don't want our principal, our main capital, we don't want that to reduce. We want to keep it the same, grow it a little bit, but never reduce it, okay? So here's some places on where to keep your emergency fund. Let's look at high yield savings accounts, right? As their name suggests, high yield savings accounts offer more significant interest rates than traditional savings accounts. Okay, that's very important. In some cases, you can earn as much as 5% APY on your balance. So that's very good, right? High yield savings accounts are particularly beneficial because they're highly liquid, which means you can get cash quickly, right? Your money is just a quick transfer away. Plus, there's no possibility of losing any of your principal balance, which we spoke about, to investment losses. And high yield savings accounts typically don't have minimum deposit requirements, all right? Let's look at money market accounts. You guys heard of this, right? The money market account. These function as hybrids between checking accounts and savings accounts, okay? They often offer interest rates that are comparable to what you get with high yield savings accounts. Remember, we talked about that 5%. And may also provide a debit card and or paper checks for easier access to your money. Now, penalty-free short-term CDs, all right? I don't know how many people are talking about CDs these days, but we're going to talk about it real quick here. Penalty-free short-term CDs. A certificate of deposit, which is a CD, is a type of account that requires you to keep your money on deposit for an entire term. During that term, your interest rate is guaranteed. CD terms can range from a few months to several years. Now, that's kind of tough if you got your money tied up for a long time and you need it for short-term emergencies. So that's something you have to think about. The drawback is that most CDs charge penalties if you withdraw your money before the account matures, which that's the point of the emergency fund. So if you experience a financial emergency, you could lose out on interest and even some of your principal deposit if you need to pull the money out early. So remember I said, we don't want to lose the principal. We do not want to lose our original capital. We just want to park our money somewhere, try to get a little interest on it, but we need our money there for our emergency fund, okay? Alternatively, you could consider a short-term CD of less than a year, all right, which is a compromise. While there's still a risk of needing to withdraw money before maturity, penalties tend to be lower on shorter-term CDs. So that's fantastic, all right? Let's keep it moving. Cash management accounts. Many brokerage firms offer cash management accounts or CMAs that you can use to store uninvested money, okay? Although they differ from traditional bank accounts, CMAs or cash management accounts may offer some of the same features you'd get with a checking or savings account, such as debit card, mobile deposit, and ATM access, which is awesome because I used to use that and kind of still do, but I don't pull the money out, so that works. They may also offer high interest rates and more deposit insurance than your traditional bank account. So these are cash management accounts. I would tell you check out Charles Schwab, Fidelity, TD Ameritrade, which Charles Schwab picked them up. So yeah, definitely check out, like if you use online brokerages, that's how I got introduced to these type of accounts. Okay, so let's talk about where not to put your emergency fund. This is very important. Long-term CDs. We talked about CDs and how it locks up your money for a while. That's not a good play here. Short-term, yes, less penalty. But long-term, as with short-term CDs, long-term CDs require you to lock up your money for a set period of time, which can be several years in the future, okay? While long-term CDs may sometimes offer higher returns, but that's not really what we're looking for. We're looking for a place to park money where we can grab that original capital or principal right when we need it in an emergency. So while long-term CDs may sometimes offer higher returns, you're more likely to need your money at some point during a period of multiple years rather than a handful of months. What's more, early withdrawal penalties tend to increase with longer terms, all right? Because they definitely want you to lock up the money so they can use it and invest to make some money. Now, savings bonds. Savings bonds are a type of debt security issued by the U.S. government, meaning that they're considered to be extremely low risk. Depending on the type of bond you choose, you may be able to invest anywhere between $25 to $10,000, all right? Sounds pretty good. However, you can't cash in savings bonds until you've held it for at least a year. So if you have a 6-month emergency, you have money tied up, can't cash out that bond. So that's really not going to work for us, right? And if you do so before the 5-year mark, you'll lose 3 months worth of interest. Not good. It can also take a couple of days to complete the process. So if you need that liquidity, that's going to take a minute. Right? You need that quick return on your cash. You need to get your hands on it within 24 hours or less. Savings bonds are not going to be a good place for you. Now, stock market. Stock market may be one of the best places to put your money to build wealth over time. But you can expect stock prices to be incredibly volatile, meaning up and down in the short term. If you experience a financial emergency during a down period, you'll have less money to meet your needs than if you had kept it in funds in a safer investment, kept the funds in a safer investment. So I do believe in keeping money in stocks, but like they're saying, you can't always count on your stock price being up. So when you cash out, you know, which we can do pretty fast with these online brokers, just sell and be out pretty much same day. You could be cashing out for less money and you have to pay some fees at some point, you know, sometimes. So that's really, stock markets are not the best place to put money. Although I wouldn't put it on the list of do not do. I would still put a portion of my money there, even in the emergency fund, maybe 25%. That's up to you. That's something you have to think about. Now, retirement plan. Depending on the type of retirement account you have, it's possible to withdraw funds without incurring penalty. For example, some 401k plan offers loans where the interest you pay goes back into your account, okay? Also, Roth individual retirement accounts, IRAs, you guys heard of that, okay? IRAs allow you to withdraw your contributions tax and penalty free. Now, here's the deal. However, you may still be penalized with the 401k loan if you don't repay it on time or if you lose your job before completing the repayment. This is very important. Also, borrowing from your retirement funds might mean that you need to save more money in the future to make up for the lost gains, because understand, there's a few days during the year that the stock market pops that you really make all your gains. You're not making all your gains 365 days of the year. There's a few days in the year that really gives your stock portfolio, your retirement portfolio, that juice, that kick, that boost. Now, here's the trick. If your money's not in the account, you will miss those days of getting it boosted. That's why they tell you, put your money in your retirement accounts and your retirement plans, don't touch it. All right, that's why we talk about having that emergency fund to the side. Now, bottom line, with so many different financial accounts available, it can be difficult to know where to put your emergency fund to maximize your savings efforts. While some types of accounts are well suited for other financial goals, it's important to choose one that covers the three basics of low risk, liquidity, and penalty-free withdrawals. Let me give it again. You want these accounts to be low risk, you want them to have liquidity, and to be penalty-free on withdrawals, okay? Take your time to research and compare several options to ensure you find the best fit for you and your family. And on top of that, don't forget to stay insured. Also, you might want to look into a whole life plan, life insurance policy that has cash value. Okay, so whole life policies, you can borrow off the cash value that's already your money built in that whole life insurance plan. So that is an option also. I appreciate you guys. Stay insured, watch your money, stay blessed, stay positive. See you in the next video.